Shifting gears over to energy, oil and nat gas, the raw commodities, also subject to a lot of geopolitical policy shifts. So, Paul, for investors looking to maintain energy exposure, you say infrastructure is a safer way to play it.
I believe that wholeheartedly, and we're going to celebrate the 15-year anniversary of AMLP tomorrow with the closing bell at the New York Stock Exchange. That's the largest, most liquid MLP ETF, which plays in the energy infrastructure space. But we've seen investors start to take notice of some of these trends. So if you look at year-to-date XLE, which is the largest, most liquid energy ETF on the market, it's had more than $7 billion in net outflows this year. It's had more than $13 billion in net outflows over the course of the past 3 years. And yet, if you look at energy infrastructure as a category, which includes AMLP and other more diversified energy infrastructure strategies, $1.6 billion in net inflows into the category year-to-date, $950 million in net inflows into AMLP so far here in 2025. And I think that speaks to the fact that advisors and investors are starting to think about energy more in terms of power as opposed to crude oil and natural gas. And when you think about it in the context of the electrification theme and how you can get exposure to rising electricity demand and understanding that our electricity mix is evolving before our eyes. We're talking about incorporating nuclear in a way that we really haven't for decades. We're seeing that natural gas not only is at 42% of our electricity generation now, but is likely to rise alongside solar and wind. And the mix of what generates electricity is evolving. And the way that investors play, quote unquote, energy is evolving. XLU has $2.7 billion in net inflows year to date. The sleepy old utility sector, which, by the way, had the best performing stock in the S&P 500 last year. And so I think the conversation about energy is evolving beyond simply, I have to own the large majors, the diversifieds, and I need to actually start to position for the companies that are going to benefit from rising electricity demand and get a mosaic of exposures to capture it.
And of course, there's so much projected AI power demand tied to all of these AI giants exploding. Tell me here, Malcolm, how are you looking at Global X and the ETFs you have to serve that kind of part of the equation?
For sure. So, I mean, big picture, as Paul mentioned, you have the kind of traditional energy side if you're thinking about oil, or more recently, if we're thinking more about what's power, and power is central to almost all technologies of tomorrow. So not only artificial intelligence, but electric vehicles, large factories, and big picture, the U.S. is sort of not ready for all of this. Cumulatively, the U.S. needs to produce about 45% more electricity than it produces today by 2040. After almost 2 decades of stagnant demand, it's really starting to pick up. So we've launched an electrification ETF under the ticker ZAP, Z-A-P, that is really focused on solving this issue and providing an investment vehicle for investors to take advantage of this theme. But it's really a lot more US focused, despite my kind of international mandate. From a US perspective, we think this domestic theme is really interesting.
Yeah, it's going to be fascinating to see how much power is actually needed and what types of power are serving those markets. Malcolm, Paul, thank you both so much for joining us for this conversation. Remember, you can catch that and all of our other content at etfedge.cnbc.com. Thanks for watching.